Taxpayers will use Schedule 3 in conjunction with their Form 1040 if they have non-refundable credits to report to the IRS, excluding the child tax credit or the credit for other dependents. So if you have one or more non-refundable tax credits, or if you have refundable tax credits and additional payments that might result in a tax refund, then you will report them on Schedule 3. So we're going to take a moment to go through each of these line items. Basically, this form is a two-page, two-part form. On Part 1 is a list of some of the most common non-refundable tax credits. And then on Part 2, on page 2, other payments and refundable tax credits. And at the end of page 2, you'll calculate the total refundable credits. You'll report those as line items on your 1040, 1040 SR, 1040 NR. And you'll notice that the number in line 15, where it says to report on line 31, is going to be a different place than the line 8 number, which you report on line 20 of your tax return. And again, that is due to the fact that there's a difference between a non-refundable tax credit and a refundable tax credit. The difference is that non-refundable credits reduce your tax liability dollar for dollar, but cannot go below zero. So if you had a $2,000 tax bill and you had a $1,000 non-refundable credit, then your $2,000 tax bill would be reduced by $1,000 and you would still have a $1,000 tax bill. However, if you only had a $500 tax bill and your non-refundable credit was $1,000, then you could only reduce your tax liability down to zero. And in some cases, you may be able to take the excess non-refundable credit and carry it forward to a future tax year or carry it back to a previous tax year if that's advantageous. And some non-refundable credits are just lost forever. You can either take it or you lose it. On the contrary, refundable tax credits, you can take them even if they produce a tax refund. So what that means is if you had a $500 tax bill and you had a $1,000 refundable credit, then that tax credit would apply to reduce your tax bill down to zero, but additionally, it would keep going and result in you receiving a $500 refund. In other words, it would be like if you had already prepaid $1,000 worth of taxes and your tax bill ended up being $500, you would get a $500 refund with your tax return. So that's the difference between non-refundable tax credits and refundable tax credits, and that's why they're reported on two different places in your Form 1040. So let's walk through this tax form. Like I said, the numbers don't really matter for this demonstration. Every situation is going to be different based on each taxpayer's unique situation. So as I go through each tax credit, what I'm going to do is relate to you where you might find this or which types of taxpayers might be eligible for certain credits. And this will be a little bit more important for some of the lesser common tax credits that a lot of people might not know that they're eligible for. So at the very top of the form, your tax preparation software will probably automatically do this, but we're going to enter the name of our hero, John Doe, and his social security number. So we'll start with line 1, foreign tax credit. So this is reported on IRS Form 1116. You may, if you paid income tax to a foreign country or a U.S. possession, you might be taking this tax credit. However, for most taxpayers, this might happen because they have stocks and bonds in some sort of securities that is a foreign source gross income. So, for example, if you own stocks and you happen to own Toyota stock, Toyota is a Japanese company, and you might be able to buy it through an American stock exchange, and you might receive dividends. I'm not sure if Toyota pays dividends, but if they did, then you might be eligible for a foreign tax credit if you had to pay taxes to Japan for that. And again, that would all be reported to you. And then if you're preparing this with your CPA or your tax preparer, they would have Form 1116 reporting all of your information. So if this is applicable in your situation, enter the amount of the tax credit. And then there are certain exceptions. You might not need to file Form 1116 if there are 5 criteria that might apply. If all of your foreign source gross income was from interest and dividends, and those were reported to you on either a Form 1099 or a Schedule K-1. 2, if the total of your foreign taxes was not more than $300 or more than $600 for a married couple filing a joint return. 3, if you held the stock or bonds on which those dividends or interest were paid for at least 16 days and you didn't need to pay them to someone else. This might happen because of an ex-dividend date where someone sells a dividend-paying stock but still is owed the dividends because they were the owner on that dividend date. If you're not filing Form 4563, which is an income exclusion form for American Samoa, or excluding income from sources in Puerto Rico. And finally, if 5, all of your foreign taxes were legally owed, not eligible for a refund or a reduced rate under a tax treaty, if they were paid to countries that the United States recognizes and do not support terrorism. So if those 5 criteria apply, you might not need Form 1116, but if you are preparing Form 1116, attach it to this tax return. And actually, unless otherwise specified in the form, you're going to attach the applicable form. So in line 2, we're going to discuss the credit for child and dependent care expenses. You can find that on IRS Form 2441, line 11. And so you might be taking this credit if you have a qualifying child under the age of 13 that is your dependent, and or if you had a disabled spouse or another disabled person that you need to pay for care for, or if you have a child that is your child but you can't claim them as a dependent because you're divorced or separated and you're playing by those tax rules. If you had to pay child or dependent care service expenses so that you could either be gainfully employed or look for gainful employment, then you would report those expenses on IRS Form 2441 and you would attach that to the tax return. So for each of these tax credits, we're just going to put in $1,000 as a placeholder. In line 3, you'll enter any non-refundable education credits from IRS Form 8863. So you'll notice this is from line 19. This is the non-refundable part of the American Opportunity Credit or the Lifetime Learning Credit. Both of those are non-refundable. There is a refundable part of the American Opportunity Credit that should not be reflected in line 19 on the Form 8863. So there are certain eligibility rules, basically income-based, as long as you're not claiming or being claimed as a dependent on someone else's tax return, as long as you're not married filing separately, and as long as either you or your spouse were U.S. citizens and not non-resident aliens. Non-resident aliens can also take an education credit as long as they were filing a joint tax return with a U.S. citizen. So in line 4, we'll enter any retirement savings contributions credits reported on IRS Form 8880. So these credits are dependent on age, so you have to be at least age 18. You subject to income limitations. So single taxpayers cannot have made more than $34,000 in adjusted gross income in the tax year. Married filing jointly, that's $68,000. And then finally, you can't have been a college student or a full-time student at any point during the tax year. Residential energy credits, you would attach your IRS Form 5695. So there are two types of residential energy credits. There is the residential clean energy credit, which is for certain pieces of clean energy sources that you placed into service during the tax year. So like solar panels, geothermal electric heat, or heat pumps, fuel cells, things of that nature. They might qualify for the residential clean energy credit, or you might also be eligible for the energy efficient home improvement credit. And this is really for improvements to your home, like insulation or doors and window installation or roofs. Certain heating or cooling components might also qualify. So you can use IRS Form 5695 to claim either or both of those tax credits during the year. In line 6, there's a long list of other non-refundable credits. I think that they're bunched here primarily because they're lesser known and probably lesser used. So we'll start with 6A, the general business credit. This is a number of business type credits that taxpayers would normally apply to individuals that are either partners in a partnership, shareholders in an S corporation, they're self-employed, or they have rental property. So you would find this on IRS Form 3800, and we'll just say that all of these apply to our hero John Doe. And again, attach these requisite forms with your tax return. If you paid alternative minimum tax in a prior year and you have a carry forward based on the calculations, then you probably will have an IRS Form 8801, which is a credit for prior minimum year tax. So you would attach that. If you adopted a qualifying child, you might be able to take the adoption credit based on certain criteria. If you paid expenses to adopt a child, or if you adopted a child with special needs and the adoption became final in the current tax year. So for more information on that, you would need to refer to the instructions for IRS Form 8839. In line 6D, the tax credit for the elderly or disabled as calculated on Form Schedule R. If you've never heard of Schedule R, chances are you probably don't qualify, but there are income, age, and or disability limitations to this. So most taxpayers don't file Schedule R. However, those who do might be eligible to take a tax credit. And then in 6E, alternative motor vehicle credits. So this is a tax credit that has been phased out by the next tax credit down, which is the qualified plug-in motor vehicle credit. For the most part, if you placed a vehicle into service before 2022, or if you bought a vehicle before 2022 and you placed it into service in 2022, then you would be able to take the alternative motor vehicle credit. You would attach IRS Form 8910. However, most taxpayers are probably going to be more familiar with the very next credit, which is the qualified plug-in motor vehicle credit. This tax credit, which you claim on IRS Form 8936, largely has replaced the alternative motor vehicle credit. It's more expansive, and it covers a little bit more of the vehicles that you would see placed into service today. Mortgage interest credit. So if you had a home, uh, if you bought a home as part of a state or a local government home buyer program, you might have received what's known as a mortgage credit certificate. And in this case, you would probably also be familiar with IRS Form 8396. So this is the tax credit for the mortgage interest that you've paid. You can take this instead of having to itemize deductions on Schedule A for your mortgage interest. If you qualify under one of those home buying programs, you can't take both. So if you're already filling out Schedule A, you can't go back and claim the mortgage interest credit, but most likely, if you're eligible for the mortgage interest credit, you're probably better off taking it. You would report it here on line 6G. Line 6H is the District of Columbia first-time homebuyer credit. This does not really apply to new taxpayers for any homes that were purchased after 2011. This is only here as basically a carry forward item from previous tax years. So if you do have IRS Form 8859 and you qualified back before 2011, then you might be carrying this tax credit over and over. This might be the year that you claim it or not. In line 6I, this is the qualified electric vehicle credit. Like the alternative motor vehicle credit, this tax credit has largely been phased out and replaced with this motor vehicle credit on IRS Form 8936. So this doesn't apply for any cars that you placed into service after 2006. And you can only claim this credit if you have a carry forward from a prior tax year. So if applicable, you would attach your IRS Form 8834 to your tax return and you would claim the electric vehicle credit. So the next one, alternative fuel vehicle refueling property credit, is actually another tax credit you would place based on the refueling property. So if you had a charging station that you attached to your house, you could take a tax credit for that. You would find more information on IRS Form 8911. In line 6K, this is for holders of tax credit bonds. So if you file IRS Form 8912, then you can report that number here. Otherwise, just skip down to the next line. And the next line really only applies to partners in a partnership. So this is line 14. This relates to the partner's audit liability under Internal Revenue Code section 6226. So if you're not a partner, then you don't need to worry about this. But if you are and you received and you reported or you have IRS Forms 8978, then enter the line 14 amount here. If that amount is negative, then you'll need to go through a worksheet which you can find either in the form instructions or in our article, which I'll discuss at the end of this video. But you can go into the article and you can pull up a copy of the adjustment worksheet, work through that, and then enter the number here. If it's positive, then you would just enter the positive number. Now line Z, this is a placeholder for any other non-refundable credits that you might have access to that are not reported elsewhere. So we don't have any for this situation, so we're going to leave this blank. But if you did, you would list the type of tax credit as well as the amount. Now in line 7, we're going to add all of these lines. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. $12,000. And then for line 8, we're going to add that $12,000 figure to this, to the first 5 lines, and we come up with $17,000. So now, this is probably not a realistic situation in that I've never met a single taxpayer that would claim every single one of these credits in a tax year. However, if you did, then these are the These are the tax credits that would apply after your payments and refundable tax credits. So if those tax credits already reduce your tax liability down to zero, then you're most likely going to be kicking this forward to a future tax year, or you're going to be trying to look for ways to carry it back to a previous tax year to reduce your tax liability. Now let's go to part 2, which is other payments and refundable credits. So in line 9, the net premium tax credit applies to taxpayers who might have bought health insurance through the marketplace. So if you're not familiar with the marketplace, if you have employer-sponsored health insurance, you probably don't have the net premium tax credit. You probably are not familiar with IRS Form 8962. Now, if you filed a tax extension from April to October for most taxpayers, then the IRS expects that you pay your anticipated tax liability with your extension to file. So the file extension is simply to give you enough time to file your tax return, but your taxes owed are still owed as of the original filing date. So if you paid any amount with your request for an extension, then you would report that here. So this would either be on IRS Form 4868 or for taxpayers that are residents or citizens living overseas. This might be IRS Form 2350. If you work for more than one employer, or if you work for an employer and you have self-employment income, then you may be susceptible to excess Social Security or Tier 1 railroad retirement tax benefits withholding. So generally most payroll providers will stop when they reach the Social Security wage base, which for 2022 was $147,000. For 2023, that amount increased to $160,200. So most payroll processors will stop withdrawing excess Social Security when you hit that limit on your wages. However, some employers might not, and people with 2 or more sources of income may very well exceed that, because one employer is still withholding while another employer stopped, or maybe the sum of both payrolls exceeds the wage base, but either one by itself does not. So if you know that you paid more in Social Security than you should have, then you can report the excess here. However, if you only had one employer that did not stop withholding, then either the employer should adjust the tax for you, and you should see that in your paycheck, or you would have to file IRS Form 843, which is a request for an abatement or a refund. If you used fuels in any way for a non-taxable purpose, but you paid a federal tax on the fuels that you consumed, then you would report that on IRS Form 4136, and that would be a non-refundable or a refundable tax credit for you. And then just like with line 6 above, a lot of these are lesser known refundable credits. So IRS Form 2439 has to do with qualified long-term capital gains inside of a real estate investment trust or a registered investment company. So if you had that form reported to you, IRS Form 2439, kind of looks like a Form 1099, but it's a little bit different. Line 2 of that form contains the amount of taxes that were paid on your behalf. So you can use that as a credit. 13B, this is a coronavirus related tax credit for qualified sick and family leave wages that were paid for leave that was taken before April 1st of 2021. So if you have household workers, you're filing a Schedule H, and on Schedule H, if you reported those wages paid in the tax year for leave that was taken before April 1st of 2021, you would enter that here. You don't put anything in a line 13C because that's reserved for future use. In line 13D, if you are claiming a credit for repayments of amounts that you included in your income in an earlier year because it appeared that you had a right to the income at that time, then you would enter that amount here. Line 13E is reserved for future use. Line 13F has to do with net 965 tax liability, which is a very obscure part of the Internal Revenue Code. So if you've never heard of it, don't feel bad. Now, line 13H has to do with qualified sick and family leave wages that were for leave that was taken between April 1st and before October 1st of 2021. So again, you'll find that also on Schedule H. The difference is that you would see this credit on line 8F as opposed to 8E for this item that you're reporting in line 13B. And then, as with the other credits, you would use line 13Z to report other credits or payments not elsewhere reported here on your return. So very obscure examples. So if you're not familiar with them, then don't feel bad at all. So in line 14, we're going to add all the line 13 numbers up, and then through line 15, we're going to line up everything from lines 9 through 12 and line 14. So this looks like that's $5,000. And then we're going to add this to the $4,000 in credits up here. And this is going to go in a different line on your Form 1040. So again, if you had $9,000 of refundable credits and payments, and then your non-refundable credits were $17,000, if you had an outstanding tax bill of $10,000, then you would go through your $9,000 of refundable credits and payments, and then you would use up $1,000 worth of your non-refundable credits. From there, you'd have $16,000 that you'd have to, probably find a place for in a different tax year, if applicable. So, but those are reported on on different lines of your Form 1040, which contain additional instructions on what to do with those excess credits, if applicable. That's all we have for this video. We go into much more detail on Schedule 3 in our article. So we cover each of these tax credits a little bit more in depth. We go over some of the requirements for these. We have links to full-length articles that we've written on the vast majority of these tax topics, and we're adding new ones every day, so keep an eye out. So if you like, you can go to our website, which is teachmepersonalfinance.com, type in IRS Schedule 3 in the search bar, and you'll see our article. You can also reach our article through one of the links in the show notes on our YouTube page. So if you like our articles, please subscribe to our newsletter. If you like our videos, please subscribe to our YouTube channel. And if you have any questions or comments, please post them in the comment section. And if you see a tax form that an article has not been written about, please post that in the comment section as well, and I'll put that at the top of my priority list when I can. So thank you very much and have a great day.